If you don't understand chart patterns, you're trading blind. These simple shapes can signal reversals, breakouts, and even trap retail traders before they know what hit them. In this video, you'll learn how to recognize and trade the most powerful patterns, including double tops and double bottoms, triple tops and bottoms, head and shoulders, inverse head and shoulders, triangle patterns, channel patterns, wedges, and more. These patterns work on all time frames and in every market, whether you trade forex, stocks, crypto, or options. By the end of this video, you'll know how to spot chart patterns correctly, how to avoid common traps that wipe out most traders, how to anticipate trend continuation or reversal, and how to predict price moves before they happen. Let's get straight into it. Let's begin with two of the most powerful and recognizable reversal patterns, the double top and the double bottom. We'll start with the double top. This pattern typically forms after an uptrend. Price moves higher, then pulls back and makes another attempt to break that high, but fails. The two equal highs create a resistance level, and the low between them is what we call the neckline. Now, what does this mean in terms of price action? It tells us that buyers lost momentum. Instead of pushing the price to a new high, they were only able to match the previous high. That signals a potential shift, from bullish strength to possible bearish control. Now let's flip it. The double bottom appears after a downtrend. Price drops, finds support, then bounces, only to revisit the same support level again, but this time it holds. The two equal lows create a support level, and the high between them forms the neckline. From a price action perspective, this signals that sellers are running out of steam. They failed to drive price lower, suggesting a possible reversal to the upside. Before we move on, jump into the comment section and let us know what topics you want us to cover next. Your input helps shape every video we make. Let's now explore how to trade these patterns. The first method is the neckline break entry. In a double top scenario, once the pattern forms and price breaks below the neckline, it confirms the shift in trend. This is your entry signal to go short, with the expectation of a continued downward move. On the other hand, in a double bottom, once price breaks above the neckline, the reversal is confirmed. That's your entry to go long, riding the new bullish momentum. Let's move on to the second variation, one that significantly increases the probability of a successful trade, the double top or double bottom forming at a key level. Here's how it works. First, identify a key support level, typically defined by at least 3 clear reversal points. As price revisits that level, a double bottom begins to take shape, signaling that the market is testing support again, but struggling to break lower. Once the pattern forms, draw your neckline across the most recent swing high. A break above this neckline confirms the shift in momentum from a downtrend to an uptrend. That's your cue to look for long entries on the lower intraday timeframes. And here's an extra confirmation technique. By drawing a trend line connecting the swing highs, you can wait for a break of structure through that trend line before committing to a long setup. This gives additional confidence in the reversal. The same logic applies in reverse. Identify a key resistance level marked by previous highs or turning points. As price returns to that level and fails to break higher, a double top forms. You then mark the neckline at the recent swing low. Once price breaks below this neckline and prints a lower low, the trend change from bullish to bearish is confirmed. This opens the door to short entries on lower timeframes. It's worth pointing out that different traders will enter at different points, and that's perfectly valid. Some may enter early on the rejection from resistance or support, others may wait for the neckline break. Pattern-focused traders may only enter after the full double top or bottom confirms. Each entry has its pros and cons. What matters is that your strategy aligns with your personality and trading style. Now let's talk about a more refined approach, the pullback entry. This variation still uses the double top and double bottom, but instead of entering on the breakout, you wait for price to pull back after the breakout for a more favorable entry point. Look at this chart example. Price forms a clean double bottom, then breaks above the neckline, signaling the reversal from bearish to bullish. Now, instead of entering immediately on the breakout, you wait for price to retest the neckline, which now acts as new support. This retest provides a second chance to enter long, and often with a better risk-to-reward ratio. What makes this level even stronger is that it lined up with a historical support zone, giving added confluence to the trade. Here's something that's critical but often overlooked. Stop-loss placement varies depending on your entry style. If you're taking the breakout entry, your stop is usually placed 10 pips below the breakout candle. But if you're entering on the pullback, your stop loss should be placed beneath the new support zone formed after the retest, not at the neckline itself. Each method has its pros and cons, but understanding where and why to place your stop is what separates amateurs from pros. Let's now move on to the triple top and triple bottom patterns. In a triple top, price is in an uptrend and fails 3 times to break above the same resistance level, forming 3 equal highs. The swing lows between the tops form the neckline. Once price breaks below that neckline, the reversal is confirmed and traders look for short entries. In a triple bottom, price is coming from a downtrend and forms 3 equal lows at the same support level. The swing highs create the neckline, and a break above that level confirms a bullish reversal, triggering long entries. The way you trade these patterns, breakout, pullback, and key level confluence, follows the exact same principles we've already covered with the double top and double bottom, so we won't repeat those steps here. Let's now break down one of the most well-known and powerful reversal patterns in trading, the head and shoulders pattern, and its counterpart, the inverse head and shoulders. We'll look at both, walk through their anatomy, and explain what they reveal about market psychology and trend shifts. Here's the basic structure. First, price forms a left shoulder, a swing high followed by a pullback. Then comes the head, a higher high that forms the peak. Finally, the right shoulder, a lower high that signals weakening bullish momentum. Now connect the swing lows beneath the shoulders. This forms your neckline. Once price breaks below that neckline and makes a lower low, the head and shoulders pattern is complete. This confirms a reversal from an uptrend to a downtrend. What's the psychology behind this? Buyers push price to a new high, the head, but fail to sustain momentum. The right shoulder forms as buyers can't break above the head, showing exhaustion. A break of the neckline confirms that sellers are now in control, and a new downtrend is beginning. Now let's flip the pattern. The inverse head and shoulders is used to spot a reversal from a downtrend to an uptrend. Here's how it forms. A swing low creates the left shoulder, a deeper low forms the head, a higher low forms the right shoulder, showing that sellers are losing steam. You connect the swing highs above the shoulders to form your neckline. Once price breaks above the neckline and prints a higher high, the pattern is complete, confirming the trend reversal to the upside. What does this tell us? Sellers tried to push price lower but failed to create a new lower low. Buyers stepped in early, forming a higher low. The break above the neckline signals that buying pressure has taken over and a new uptrend is likely starting. This pattern is especially valuable when combined with other confluence tools like key support zones, volume, or intraday confirmation. Now that you understand the structure of the head and shoulders and its inverse, let's talk about how to actually trade them. Starting with the breakout entry, one of the most direct and widely used methods. Once the pattern forms, left shoulder, head, right shoulder, you draw the neckline by connecting the 2 swing lows beneath the shoulders. The entry trigger comes when price breaks below the neckline. This breakout confirms that the market has shifted from bullish to bearish sentiment. At that point, you can enter short either on the candle close below the neckline or wait for slight continuation to confirm momentum. Your stop loss is typically placed just above the right shoulder or above the most recent swing high, depending on your risk tolerance. Your target can be projected using a measured move, the vertical distance from the head to the neckline, then projecting that distance downward from the breakout point. In the bullish variation, the inverse head and shoulders, you follow the same concept. Pattern forms with a left shoulder, head, and right shoulder, but in a downtrend. Draw your neckline by connecting the 2 highs above the shoulders. Once price breaks above the neckline, that's your long entry signal. You can enter on the breakout candle close or wait for a slight continuation to confirm buying strength. Your stop loss goes just below the right shoulder or beneath the recent swing low. For target projection, measure the distance from the head to the neckline and project it upward from the breakout point. That gives you your first potential take profit zone. Now let's take things a step further and talk about the pullback entry, a more conservative approach that gives you added confirmation and often a better risk to reward ratio. This method waits for price to retest the neckline after the breakout before entering the trade. Once the head and shoulders pattern completes and price breaks below the neckline, you don't enter right away. Instead, you wait for price to pull back and retest the neckline, which now acts as new resistance. Here's how it plays out. Price breaks below the neckline, confirming the trend shift. It then retraces back to the neckline area. You wait for signs of rejection, such as a bearish candlestick pattern, a wick, or a lower timeframe confirmation. Once rejection is confirmed, you enter short. Stop loss, just above the neckline or above the right shoulder. Take profit, the next major level. Same concept, flipped for a bullish setup. Price breaks above the neckline, confirming the reversal. It then pulls back to retest the neckline, which now acts as new support. Wait for confirmation, bullish engulfing candle, a pin bar, or strong lower timeframe reaction. Enter long on the rejection. Stop loss just below the neckline or below the right shoulder. Target the height from head to neckline projected upward from the breakout point. Now let's move on to another powerful chart pattern, triangle patterns. There are three main types of triangle patterns in technical analysis: the ascending triangle, the descending triangle, and the symmetrical triangle. Let's start with the ascending triangle. In an uptrend, the ascending triangle typically acts as a continuation pattern. Here's how it forms. The top side of the triangle forms a flat resistance level as price makes equal highs. The bottom side shows higher lows, which lets you draw an ascending trend line pushing upward. This pattern reflects building buying pressure as buyers keep stepping in at higher levels. Now, two scenarios can play out. If price breaks above the resistance, it confirms a bullish continuation. But if price breaks below the ascending trend line, it can indicate a reversal to the downside. Let's look at this on the chart. The price was in an uptrend, forming equal highs and higher lows, a classic ascending triangle. When it broke above the resistance line, the move signaled a continuation of the trend. Had it broken below instead, it would have confirmed a reversal. The same pattern can also appear during a downtrend, and in this case the meaning shifts. The market is moving lower, but buyers begin stepping in earlier, forming higher lows. However, price keeps getting rejected at the same resistance level, creating that horizontal ceiling. This forms the ascending triangle once again. From here, if price breaks above the resistance, it signals a bullish reversal from downtrend to uptrend. If price breaks below the trend line, the pattern acts as a bearish continuation and the downtrend resumes. Look at this chart example. Price is in a downtrend, builds the triangle with equal highs and rising lows. The break below the trend line confirmed bearish continuation. But had price broken above, it would have been a bullish reversal signal. Now, let's take a look at the descending triangle, another common pattern used to anticipate both reversals and continuations depending on market context. In an uptrend, the descending triangle can sometimes signal buyer exhaustion and a potential reversal. Here's what to look for. Price is moving higher overall. The top side of the triangle forms lower highs, allowing you to draw a descending trend line. The bottom side shows equal lows, forming a clear horizontal support level. This pattern reflects growing selling pressure as each rally loses strength. Now, two outcomes are possible. A break below the support level confirms a trend reversal to the downside. A break above the descending trend line can signal a continuation of the uptrend, showing that buyers have regained control. Here's how it looks on the chart. Price is in an uptrend, forms equal lows and lower highs, giving you the descending triangle. When price breaks above, it confirms a bullish continuation. But if it had broken below, that would have indicated a trend reversal to the downside. Now, flip the context. The descending triangle during a downtrend is one of the clearest continuation patterns. Price is trending lower. The descending trend line forms from a series of lower highs. The support level remains flat, marked by equal lows. This setup signals that sellers are still dominant and pressure is building toward a breakdown. When price finally breaks below support, the downtrend resumes with confirmation. Of course, there's still the possibility that price breaks above the descending trend line, in which case it may signal a reversal to the upside, but this is less common in strong bearish trends. Here's what it looks like on the chart. Price is in a clear downtrend, forms the descending triangle, and eventually breaks above resistance, confirming a bullish reversal. So whether you're seeing this pattern in an uptrend or downtrend, remember this: break below support typically signals bearish continuation or reversal. Break above trend line may signal bullish momentum returning. Always combine triangle patterns with additional confirmation like volume spikes, candlestick rejections, or key support and resistance zones to improve reliability. Next up is the symmetrical triangle, a neutral pattern that can lead to either a trend continuation or a reversal, depending on how price breaks out. Here's how it forms. Price is in an uptrend. The top side of the triangle shows lower highs, forming a descending trend line. The bottom side shows higher lows, forming an ascending trend line. The pattern reflects a tightening range. As buyers and sellers battle for control, price gets squeezed into the apex of the triangle. Now, the breakout direction gives the signal. A break above the upper trend line signals a bullish continuation. A break below the lower trend line may indicate a reversal to the downside. On the chart, you'll see an uptrend transitioning into a symmetrical triangle. If price breaks above, the trend likely continues. If it breaks below, it can signal a shift in market sentiment. This same logic applies during a downtrend. Price continues to make lower highs and higher lows, forming that classic triangle shape. The market enters consolidation as neither buyers nor sellers have full control. Once again, a break below the triangle often signals a bearish continuation. A break above may suggest a bullish reversal, though this is less common in strong downtrends. On the chart, you'll see the preceding downtrend, a symmetrical triangle forming and then a breakout in the opposite direction, usually a signal that the bearish move is reversing into a new uptrend. Now let's move on to the next key structure in our pattern series, the channel pattern. Channel patterns come in three main variations: ascending, descending, and horizontal. Each one offers valuable insight into market behavior and helps traders anticipate high probability moves. Let's start with the ascending channel. In this pattern, the top boundary is formed by a series of higher highs, allowing us to draw an upward sloping resistance trend line. The bottom boundary is made of higher lows, giving us a parallel support trend line. These two lines move in the same upward direction, forming a rising price corridor. This structure can appear in both bullish and bearish markets. In a bullish scenario, the market is already in an uptrend and the ascending channel is just a continuation, a consolidation before price pushes higher. In a bearish scenario, the pattern forms during a counter-trend rally inside a larger downtrend, and a breakdown below the channel often signals the continuation of the bearish move. Next is the descending channel. Here's how it forms. The upper boundary is defined by a series of lower highs, giving us a downward sloping resistance line. The lower boundary follows lower lows, forming a parallel support line underneath. Both trend lines slope downward, and like the ascending version, this pattern shows up in both market conditions. In a bullish setup, the descending channel can appear as a corrective pullback in an uptrend, and an upside breakout may mark the resumption of bullish momentum. In a bearish setup, it confirms a continuation when the pattern forms during a downtrend and price breaks through the lower boundary. Finally, we have the horizontal channel, also known as a range or consolidation zone. The top side is created by equal highs, allowing for a clear horizontal resistance line. The bottom side is formed by equal lows, which defines horizontal support. The range is flat, and both lines are parallel across the chart. This setup also develops in both trends. A bullish horizontal channel forms during an uptrend and usually breaks to the upside. A bearish version appears during a downtrend and often breaks to the downside, continuing the larger move. Once you've identified a channel, there are two main ways to trade it. Range trading. Buy near support and sell near resistance while price stays inside the channel. Place your stop loss just outside the boundary to avoid false breakouts. Breakout trading. Wait for a confirmed break outside the channel and enter in the direction of the breakout. For risk control, place your stop 10 pips beyond the breakout candle to avoid market noise while protecting your capital. You can also measure the height of the channel and project it from the breakout point to set your profit target. Now let's move on to the next formation in our chart pattern series, the wedge pattern. There are two main types, the rising wedge and the falling wedge. And while they may look similar to channels at first glance, their converging nature makes them uniquely powerful reversal or continuation signals. Let's start with the rising wedge. The top side of the wedge connects a series of higher highs, forming a rising resistance trend line. The bottom side connects higher lows, creating a rising support trend line. But here's the key difference. The two trend lines are converging. They get closer together over time, showing that the bullish momentum is weakening. This pattern can develop in both market directions. In a bullish trend, the rising wedge acts as a potential reversal. It signals buyer exhaustion and often leads to a bearish breakdown. In a bearish trend, it can appear as a counter-trend consolidation, with the breakdown continuing the larger downtrend. Now let's look at the falling wedge. The upper boundary is made up of lower highs, forming a descending resistance line. The lower boundary is built from lower lows, creating a descending support line. Just like the rising wedge, both trend lines converge, but this time they slope downward. This structure also forms in both bullish and bearish environments. In a bullish trend, a falling wedge may show up as a brief pullback, and a breakout to the upside often signals the continuation of the uptrend. In a bearish trend, the falling wedge can act as a reversal pattern. The downward move slows down, and a break above resistance can mark the start of a new bullish phase. And that wraps up today's breakdown of chart patterns. If you learned something valuable, hit that like button, subscribe, and ring the bell so you don't miss the next trading setup that could level up your game. Thanks for watching, stay disciplined, trade smart, and I'll see you in the next video.